Hey guys, welcome to the channel here this week where we're going over what was going on in the markets this week. A much more mixed week. You guys can see red in here, but mostly dominated by the earnings of NVIDIA. So this week we're going to be going over market indicators news for the markets in general as well as for the portfolio. And then we're also going to be going over a full review of FWRD Corporation, a company that I found and you guys are going to learn a lot about today. So stick around for that. And bear with me, we are in a new spot this week, taking a little vacation, but still wanted to get this out to you guys. So with that, we're going to jump right in. First off, for some news, Morgan Stanley throws in the towel. S&P 500 price target raised by 20%. If you guys follow me on X, I sent this out as soon as I saw it, as it is just a fantastic example of opinion following the trend. People think that the news drives the market. That is definitely true to some sense, but oftentimes analyst recommendations or banks' estimates of where the market's going to end up at is based on recent price movements, not the other way around. So important to understand that these companies, as the markets rise or fall, they're going to raise or lower their estimates just to look more correct, more right. And we're seeing more and more companies say, hey, we were wrong. We're just going to follow whatever the market's doing. So another one there. Bank of America sees potential for further USD selling by commodity trade advisors. That'll be good news for emerging markets and China as the US dollar weakens. So some good news there. And what are active managers doing these days? Buying AI, says Bank of America. If we look down here, they said that they screened the S&P 500 for stocks that saw the largest increase in ownership breadth over the last 12 months measured by the percent of funds owning each ticker. Unsurprisingly, 9 of the 10 stocks on our list are AI or tech related, with the only exception being Eli Lilly. The note also revealed that NVIDIA Corporation has become a key holding owned by 68% of funds and overweight by approximately 50%. There are a ton of these big name companies that are jumping on the train of shiny objects. And when you've got everyone buying into a company, essentially just by that definition, there are no more sellers left. And really when you think about these different big firms, Bank of America, and you think about hedge fund managers, people managing hedge funds, you would think that they would be the ones picking contrarian stocks because they know they have outsized performance, when it's actually the exact opposite. Oftentimes they're just all jumping on the bandwagon of whatever's doing well, and usually once everyone's in, that's when you know things are going to start looking ugly. NVIDIA certainly is a fantastic company, but it is pretty egregiously overpriced in my opinion. So I thought that was interesting. Moving on to some quick news about China. China's economic growth has entered a new era. And they talk about here how much of this is being driven by high-tech and clean energy industries. China in general is behind the US when it comes to integrating technology, cloud, all of that kind of stuff, AI. And so they're still going to be going through some of the recent growth that we saw in the US of, the crazy accelerated growth in cloud for AWS, for Microsoft, for Google, all these companies. That's going to be starting to happen in China. And also China is a massive investor into clean energy, especially solar, which is why there has been such high demand and why in the past prices for polysilicon rose very, very high and then dropped really just down to rock bottom because there was so much investment put in here for manufacturing. They also talk about here in the first quarter, China's GDP increased by 5.3%. Industrial production grew by 6.1%. High-tech manufacturing growth of 7.5%, which accelerated by 2.6 percentage points from the fourth quarter of 2023. And investment in high-tech industries has experienced robust growth, increasing by 11.4% from the previous year. So China's really hitting hard on high-tech investment and renewable energy. So we'll see kind of where that takes them. But I think everybody's counting China out when they are still a country of over 1 billion people and have one of the fastest growing middle classes in the world. So they still have a lot of potential, and I think people are missing it. So moving on to the next one here. by Caxton Global. Overseas buyers snap up China stocks amid housing measures. Recently, China has put in a lot of measures to help support the housing sector, which has really been the bane of the country for the last couple of years. It certainly has in the past. And every single time this happens, they're stepping in with different stimulative measures to boost that sector, since 70% of their population has their money tied up in real estate investments. I might be quoting that a little bit wrong, but there's a significant portion of their investments are in real estate, and so it's very important for them to get that in check, and they're going to be doing it, I have no doubt. Eurozone consumer confidence rises to negative 14.3 in May. Certainly negative 14 isn't a great consumer confidence, but just lets you know the Europe and consumer confidence there is rising, which will be good for markets. The Eurozone also saw May business growth at year high, which the PMI shows. Saw the Purchasing Managers Index compiled by the S&P Global climbed to 52.3 this month from April's 51.7, beating expectations for a modest lift to 52. And this looks as good as it could be. That's what they say here. So just some more good news for Europe. I think this is another place that people are counting out. It's underperformed the U.S. for a long period of time. And particularly while the U.S. is at a very high multiple, I think looking elsewhere in the world is you get better bang for your buck, really, when it comes down to it. Moving on to specific news for holdings. Boeing. This is when Boeing stock recovery may start by TD Cowen. And they talk about in here where they expect free cash flows of $10 billion by 2026 despite the current hurdles. Again, this is just a company that are not going away anytime soon. Sure, things look really, really rough right now, but when you have a company that operates as a duopoly with Airbus, and Airbus alone is not able to satisfy all the demand in the industry, not even close to it. In fact, each of these companies has orders years out, and I would not be surprised to see that pushed to more than a decade out in years to come. There's just incredible demand here in a very, very expensive industry to really get into. They've got a fantastic moat, and I expect Boeing to make a recovery as a new CEO comes in and they're able to right the ship. I also noted Boeing sees free cash flow burn in 2024 as deliveries remain sluggish. There was this news along with some news of restrictions to exports to China. Boeing fell, but really this is another story, and I keep seeing it so often where there's these companies that are down from their highs on whatever news it might be, and as the turnaround starts to happen, usually there are some pretty big bumps along the road, meaning they're going to report earnings and they're going to be showing progress towards whatever goals they have, but for whatever reason, the market participants feel it's not happening quick enough, and so already depressed companies will start to fall further. And I really hope Boeing falls further so I can pick up some more stock at lower prices, but it's something that I'm seeing happening over and over again right now. So some important information to pay attention to. Some news about Alibaba. They plan to raise $4.5 billion through convertible notes offering, and they're using this money to buy back more shares. I really like this play from the company. While their stock is trading at extremely low multiples, trading far below its fair value, they're looking at pretty much any and every way possible to buy back shares and increase ownership for current owners without us even having to put another dollar into the stock. They're doing a lot here. I'm sure that they could figure out ways to do more, and this is one of them. So more good news there. This was some interesting news for Dow. And again, if you guys follow me on X, I had a quick post about this. Price wars, infrastructure hurdles hurt China's solar industry. So in China, because they've had so much investment into clean energy and the demand just absolutely skyrocketed, the supply wasn't able to keep up. And so a few years ago, the price for polysilicon, which is an important key material for solar panels just absolutely blew up. And things got crazy expensive there. And while that happened, it was very profitable for new manufacturers to enter the market. And so there was a huge influx of manufacturers there, and the current ones increased their production capacity. And because of that, there is now an extreme oversupply in China. And they're recognizing this now, but it was part of my philosophy for DoCal that overcapacity would continue to drive prices lower. And just like I say here, overcapacity of solar panels has driven down their costs dramatically, leading to solar energy giants like LOGI to call on Beijing to crack down on unsustainably low prices. So because of this crazy oversupply, prices have now fallen below cost for these suppliers. But this is actually something that I was counting on happening for DoCal. Because they have an extremely strong balance sheet, they would be able to weather the storm, whereas other companies were going to fall by the wayside, either go bankrupt, just exit the market due to unprofitability, whatever it might be, and cause the supply to fall, while the demand, at least from what I can tell, seems to be staying sustainably high. Just China as a country with over 1 billion people in population needs an incredible amount of energy, especially as they're transitioning, like I said, to a lot more technology, cloud, really just integrating that like the US has over the last 5 or so years. China's going to be doing the same thing, and their energy demand is going to be rising pretty rapidly, especially as their population becomes more wealthy. The more wealthy the population you have, oftentimes, the more energy they consume. And so kind of the factor of all those things was my assumptions for DoCal. But you see here that they potentially could be cracking down on the unsustainably low prices. And whatever that might be, maybe they'll put a price floor on here so that way even higher cost producers would still be profitable or at break even. That kind of undercuts the assumptions that I had for DoCal. And this could be a very interesting development. It may end up actually leading to me completely divesting from DoCal, just because it will prevent there from being another cycle of high polysilicon prices, which is really what I was betting on to really drive a lot of hype, I guess, around any polysilicon manufacturers, like happened in 2021. So we will see what happens here, but this was some pretty big news that I wanted to pass on. So we will see what happens. I'm going to be keeping a close eye to see if China comes out with anything plans that they have here. So far, it was really just, you know, a call for help, and Beijing saying, hey, you know, we're paying attention and we're going to look at some options here. So we will see, but some important news that I wanted to pass on. Also found this article where they say natural gas to hit $3 by 2025 on AI boom. In the country, as AI gets more and more integrated, again, it's just another form of automation and integrating technology that's going to cause energy consumption to rise. And one of the best places for the US to get energy right now is in natural gas. And this is exactly the play that I have on Comstock Resources. So we'll see if this happens. Natural gas has already been on the rise, so we will see where it goes from here. Moving on to some news about Nigeria, their central bank delivers another big hike, the third this year. Another investment in their portfolio is IHS Holdings, which is a cell phone tower company in Nigeria. They're the largest tower company there. And one of the biggest things that's been hurting that company is the devaluation of the naira against the dollar. Their central bank is taking action. I did see some strength when this news came out in the naira. Certainly just a tiny drop in the bucket compared to the devaluation that's happened. I believe in the first quarter it was almost a 70% devaluation of their currency. So they still have a whole long way to go. But this was some important news. I think things will start to stabilize. If the central bank has to raise rates more, so be it. But I think things are going to start to stabilize there, and some good news for that holding. So On to some auto news for the U.S. In this article on MSN by Reuters, U.S. auto sales set to modestly rise in May, report shows. And that will be good news for Cooper Standard, as we see new vehicle sales in the U.S. are projected to rise in May from a year earlier, helped by demand for crossover SUVs, pickup trucks, according to a joint report industry by consultant J.D. Power Global Data on Thursday. So, as more sales from the auto industry happen, that's going to be great for Cooper Standard and should be a boost there for their turnaround. This was also some news that an article that I found interesting. The average U.S. vehicle age hits a record 12.6 years. High prices force people to keep them longer. So as the fleet of vehicles just in the country gets older, you're going to see turnover start being forced, I guess is a way to put it. So again, some good tailwinds for Cooper Standard. Then the last piece of news that we've got was some news from Warner Brothers Discovery, where they announced the pricing terms of a previously announced cash tender offer. They look like they're going to be offering some bonds out to pay off some more current or higher interest debt that they have on the balance sheet, which will be really important for them to just delever there. So some good news for Warner Brothers and really overall for the portfolio. I want to go back now, and we're going to be taking a look at some market indicators. Totally did that out of order, but that's all right. So one of the first things that I wanted to look at was the US dollar, and something that we touched on last week, just kind of the bet that the continued rollover of the US dollar to a downtrend is something that I'm kind of playing for here, and I expect to happen as the Fed lowers rates. That will be a big driver for the dollar down. So we're starting to see that happen. As you guys can see here, I expect this to continue. Another piece of information from GDP Now, where they take current data to essentially predict what they expect the current quarter's GDP to look like. And they just released some new data on the 24th, which is yesterday. And they're looking at Q2 GDP of 3.52%, which is up from last quarter, just showing continued strength in the U.S. economy. Now going on to the AAII, this week on the 22nd, you can see there was a pretty big increase in the bullishness of the market. A lot of that coming out of the neutral piece, and funnily enough, the day after this happened, the market was particularly down. As more and more people pile into the bullish camp, that's when you start to look for different plays for the market's pullback. It wasn't at any crazy extremes here, but just interesting to see the day after this came out, there was a pullback. Now looking at some different sectors and the number of stocks above their 200-day moving average, and just some of these sectors that are maybe a little bit more boring. They're not tech, they're not semiconductors, but just some important information that I thought was valuable to see what sectors are just kind of getting overlooked right now. So you can see the consumer staples, only 54% of stocks in that category are above their 200-day moving average. The consumer discretionary, only about 52% are above their 200-day moving average, and real estate, just about 51.5% are above that moving average there. Just interesting, and I always pay attention to these charts for different sectors to potentially find opportunities in depressed areas within the market. You can really look for high quality companies here that are depressed and buy them below their intrinsic value. So something I'm always paying attention to. These are certainly not levels where I'm, looking for great opportunities. That would be more down here in these levels, but just some important information to pay attention to. You can see that there are areas of the market that are priced differently than tech, semiconductors, that really seem to be driving things, the Magnificent Seven. So important to pay attention to. All right, from here, we're going to move on to the full review of Forward Air Corporation, ticker symbol FWRD. This company is an asset-light freight and logistics company that specializes in less than truckload and intermodal drayage services across the US, Canada, and Mexico. They're services that typically require precision execution, such as expedited transit, delivery during tight time windows, and special handling. This is another logistics play that I've kind of been looking at, and you guys will see what conclusion I came to. This company, Expedited Freight, accounts for about 80% of revenue, while the last mile freight is about 20%. That's the intermodal, which is that first and last mile, accounts for 20%. So currently this company is down very far from their all-time high, and the context around here is there was a sharp downturn in revenue, net income, and free cash flow due to weak demand, large integration costs from a recent Omni acquisition, along with pricing pressures on freight. The Omni acquisition as well was very controversial and messy, with Forward trying to back out of the deal at one point, but being forced into the follow through on the acquisition. And because of this, the CEO of the company actually ended up resigning. So they've had a full replacement of their CEO, CFO, I believe other upper level of management as well, and just caused a really messy time for this company, which is down from over $100 a share to around $12. To address the current situation for this company, their sharp decline in free cash flow, which I'm going to focus on, was due to several different factors, including seasonality. The sharp drawdown was in Q1, which is seasonally a pretty weak time for the company anyway. And they're also suffering from different cyclical issues right now that are just compounding the issues that they're having with the integration of Omni, and they had other costs related to the merger of Omni that showed up as well. Costs related to the merger in Q1 2024 were $64 million, $58 million of transaction and integration, and $6 million of severance, which they expected to be lower next quarter. The total operating expenses from last year are up 95%. As important to note here, last year they obviously didn't have Omni, and so a lot of those costs are coming from there. So they had costs up 95%, but their yearly revenue is only up about 51%. And you can imagine how that would cause them to fall into negative free cash flow, net loss, and just overall very poor performance. After the acquisition, the management did say that they're committed to aggressively taking action to improve profitability, which is some good movement there. They definitely have a lot of work to do, and it's important to note as well that the decline in revenue was already happening off a peak yearly revenue in 2022 due to lower demand and pressure on prices. Here was an important chart that I thought was valuable in seeing the retailer's inventory to sales ratio. You can see it had been on a steady decline as retailers had just gotten more efficient in understanding what they needed and when, but it fell sharply after COVID as companies just weren't seeing enough inventory come. There were supply chain issues, and they just weren't able to stock up on the inventory they needed. And then all of a sudden they got a lot back all at once, but it's still far below historical levels, sitting at about 1.3 times the sales ratio. And previous to COVID, it had been sitting maybe at an average about 1.45 times that ratio. The logistics and shipping industry is very cyclical, and we are right around where things will rebound as companies start restocking to get back up to these historical levels. And this is shown in the earnings call that this company had, where they discussed a turnaround starting to happen in the most recent months. Also in that call, they mentioned there will be cost synergies from their acquisition, which are expected to save about $55 million per year by the year end of 2024 and $75 million by the year end of 2025. It's important to know as well that even with the declines across the board in revenue, free cash flow, and profits, their shipments per day were up 1.4%, weight per shipments were up 7.4%, and revenue per shipment, excluding fuel, was up 0.7%. This does let me know that even that there are issues with pricing pressure and merger cost for the company, they are still able to pick up more business. Although currently it's not profitable, they're going to be working on cutting costs. So it's mostly pricing pressure and merger costs that are really making this company suffer right now, but it should be a short-term problem. And this is supported by the chart below, which peaked in 2022, the same time as Ford's revenue peaked, and has been in contraction since. This is the PPI for general freight and trucking, long distance truckload. You can see that it hit a peak of 37.5% up from a year prior, but since then just absolutely fell off a cliff and has been in contraction for quite some time, probably around a year since then. And we're going to talk about why this could be changing here fairly soon. And a turnaround in those freight prices would be a key tailwind for this company. And according to this article, we're already starting to see it happen. This article that I was able to find at coyote.com, they talk a lot in detail about the trucking and freight industry, giving details of the cyclicality in the past. And this is something that they had to say. Freight volumes are still lagging, but this spring is showing some green shoots. Though we may not be in an economic recession, we are in a freight recession. As you guys saw, the price for freight has been in contraction for over or around a year now. So they're seeing that here, and at least in terms of truckload shipping volumes, while shipping demand might not come roaring back this quarter, there are a few reasons to be hopeful conditions are improving. Both the cash shipment index and the ATA truck tonnage index are showing year-over-year decreases. However, they picked up steam in Q1, getting closer to year-over-year inflation. The ISM manufacturing PMI registered 50.3% in March, up from the 47.8% in February, with the U.S. manufacturing sector moving into expansion for the first time since September of 2022. And according to the DAT in Q4, we saw load-to-truck ratio drop to its lowest level in Q2 2016. And in Q1, it was up 13%, a hopeful sign of more shipments against a right-sizing carrier base. They had some great charts in here that detailed the market cycles, where they look at truck orders versus the spot freight price year over year. And you can see that we've gone through several cycles since 2007 till now, where there has been sharp rises and declines falling into contraction, which happens fairly often, and we are just coming back to another expansion piece. As soon as we cross above here, that will be the end of this cycle and a start of a new one, where you guys can see every single time it crosses up meaningfully. You can see right here it tried to, but as soon as it crosses up meaningfully, we're usually seeing sharp increases in freight prices. And this is exactly what they're expecting to happen. And this is what they have forecasted here. I said year-over-year spot rates will likely flip back into an inflationary environment in Q2, ending the fifth observed truckload cycle, which has been one of the longest. As you guys can see, the length of time that most of these have happened from 2017 to 2020, about 3 years. But 2020 to 2024, 4 years there, is longer than any of these other cycles. And they also talk about this blue line here, which will be the number of vehicles sold into the industry. So some good news there, starting to see some turnaround, and another industry that's just incredibly cyclical. And when you have a cyclical industry like this, you can really pick your timing to when things are the most depressed to then buy into high quality companies. And we're going to be talking more in depth about this company, their financial position here. But as an industry as a whole, it's coming back to growth. It's not going to be an incredible grower over the next decade or so, but it will still have some tailwinds and some short-term tailwinds as the spot rates for freight come back into inflation. Moving on here to the business fundamentals of the company. The competitors in the industry had a revenue CAGR of about 10.45%, free cash flow margins of about 3.42%, and net margins of about 3.43%. You can see Forward Air here had revenue growth of just under 10%, which is right around market average, but they did have higher margins, higher median margins over the lifetime of their company, which goes back to 2007. Their free cash flow margin sitting at 7.95% and their net margin sitting at 7.73%. Solvency, this is one of the biggest issues for this company right now with the merger that they had with Omni. Currently, assets and potential loans, liquidity that they have available to them, they have $172 million in cash and equivalents, receivables of $352 million, and available in a revolving credit facility, they have $340 million available to take there. Their current liabilities and interest expense, they have total current liabilities of $445 million and total long-term debt of $1.664 billion. They also have interest expense of $160 million, which implies about a 9.6% interest rate on their total long-term debt. And their historical free cash flow has sat around $150 million. On the call as well, they noted that they're looking to divest from non-core assets to raise capital for debt repayment. This is where I pulled a lot of this information from, as well as from their balance sheet and reporting there. $172 million of cash available, $340 million in a revolving credit facility. A lot of the long-term debt that they have as well, you can see about $1 billion matures in 2030 and $725 million matures in 2031. So they don't have any of that long-term debt coming due really quickly. In fact, none within the next 5 years. But when you compare the interest expense that they have to their historical free cash flow, which their historical free cash flow is going to be a little bit low as it's pre-merger, where if they're able to generate comparable margins here, free cash flow margins, their free cash flow should be significantly higher, but even if it is 50% higher from here, interest expense eats up a significant portion of that. And so this is by far the most important area to understand and to have very, very clear for me is how they're going to turn this around. And one of the things that was key there is that they're looking to divest from non-core assets to raise capital for debt repayment. And if they're able to pay off a significant portion of this, that could be a really, really good sign for this company that they're able to stabilize and move forward. So we'll see. That'll be news coming down the line. They didn't offer anything other than just this idea that they're looking to divest, but we will see. Also, some information that could be important. The majority of their debt is variable rate, and this can be a good thing and a bad thing. If rates fall, it is great news for this company, and their interest expense will fall, which is probably the most likely scenario, so it's probably a plus, but it exposes them to more risk than I think necessary. I would certainly prefer a high credit quality company that was able to get low fixed interest rate loans so you can have a very clear picture of what's happening. This just exposes them to more risk, but could potentially be an asset if rates fall. Also important to note, they are an asset-light business, so they have very low capital expenditure needs, only about 1.1% of revenue in 2024, Q1 2024. Looking at the returns that the company gets on assets, invested capital, and equity, the competition that they have in the industry has an ROA of about 6.9%, ROIC of 14.5%, and return on equity of 14.5%. You can see here, Forward sits pretty much in line with the industry for the most part. They have a higher return on assets of about 10.36%. slightly lower return on equity, 13.8%, and a just slightly higher return on invested capital at 14.7%, sitting pretty much in line. So really the only advantage that I see that they have against the industry is they seem to have a little bit higher margins overall than the industry as a whole, which is a good plus there. Also important to note on how the management's performing is how are they respecting shareholders of the company? Are they diluting them, issuing shares? And for this company, they are not. They have had a cumulative average growth rate of about 1% in their shares outstanding, which are down 16% since around IPO, which is great news. Turning to the history of their management and earnings calls, it's a little bit hard to judge on the earnings calls as we've only actually had one earnings call with the new CEO, first quarter there, and the new CFO was actually appointed after that earnings call as the previous CFO stepped down. So on the earnings call, I found that the new management is neither outstanding nor poor in their communication. Say they're pretty much right around average in how they communicate, how things are operated. Typically, I like to look for management that is comfortable pointing out the flaws and the issues that they have going on, and it can communicate really clearly. That tells me that they also know how to communicate internally really well and set a vision for the company to just get things going. But it was right around average from what I could tell, but it was also the first quarter. So we'll see in coming quarters how they're able to communicate what's going on internally in the company and what the financials are looking like, what the future is, all those things. Like I said, due to the new CEO and CFO, there's no real track record of them cutting costs here in this company, which will be a key for their future. However, with the new leadership in their past endeavors and companies that they worked for, here is what I found. The CFO that they just appointed in the interim, Jamie Pearson, was the master of the restructuring of YRC, less than truckload logistics company as well, and kept the negative free cash flow company afloat for many years while he was there. I went and looked at the financials of this company, and they almost never generated free cash flow. And even when they did, it was often almost all eaten up by interest expense on their debt. But yet he was able to figure out a way to keep restructuring things to keep the company going, even when it was almost never profitable. And tells me that he was instrumental to that company. He was also there and was able to lower the total debt of the company, dramatically reducing the debt to EBITDA levels as EBITDA largely remained flat during that time. So he's got a good track record of allowing companies and giving them more runway than it looks like they should have. FWRD, I would certainly say, is higher quality than YRC. I wouldn't say that they're the highest quality by any means in the industry, but they're much higher quality than YRC. As for the CEO, Sean Stewart, he has a lot of experience in logistics, about 30 years if I remember correctly, and creating great product for their clients. That seemed to be his main focus at the previous place that he worked at, Siva Logistics. And while he was there, under his leadership, he was able to help the company experience substantial growth and operational improvements, including a nearly 25% increase in net promoter score and a double-digit reduction in direct operating expenses. I'm not too concerned about this here, as it seems that FWRD already has a great relationship with their clients and they're still continuing to win business. What I do care about is their reduction in direct operating expenses. Like I mentioned, their expenses are up almost 100% year over year, while their revenue is only up about 50%. So they need cost cuts fast, especially when you look at their historical free cash flow to interest expense. To be able to cover that, they need to be more lean and efficient than they were before. So this is the main focus for this company, and I think that they have leadership that is in a position to do so. So this is a little bit of a summary for everything that we've talked about so far. Forward Air has had some major structural changes, including a controversial merger and essentially a complete reset of upper level management. They will need to return to positive free cash flow. They need to cut costs and pay off debt to get things back on track. I do think that their management is well equipped to make those changes needed, and the industry as a whole looks to have bottomed and is turning back up to rising prices. But it may still take some time to see this reflected in the revenue, and I believe that we should start to see that in the second half of 2022. My biggest concern by far is their debt load and the fact that interest expense is essentially going to eat up all of their free cash flow. If they're not able to use the cash from the potential sale of assets to delever their balance sheet, things look very improbable for a proper turnaround, since they will only have a few tens of millions of dollars to pay down debt each year with a debt load of $1.66 billion. So before I can feel comfortable making any investment here, I would need some guidance from the company and leadership on what the expected outcome from the sale of non-core assets will be. And once I have that, if it's favorable, then this could be a phenomenal investment. They are down significantly from their all-time highs in a market that has some tailwinds in the short term, and they're going to continue growing in the long term. It could be a fantastic turnaround play. However, there's just not enough confidence that I have in this company to really understand that they're going to be able to get back to positive free cash flow, and if they do, are they going to be able to reduce their debt load enough that their interest expense doesn't eat up everything that they have. So we will see what this looks like, but overall still need more information, more color on what the expected outcome is on that sale of non-core assets. For me right now, it is a pass, although I wanted to share this with you guys because it was such an interesting review of a company for me, and to look at what the potential here is, we'll move on to this last piece where I look at some valuation and goals for the company. They have a median free cash flow of about 8.4%, and while I was unable to find data on Omni, they do have a historical lower EBITDA margin than Forward. So we'll make a conservative estimate of about 5%. And with that said, if free cash flow margin just returned to the historical medians with no return of revenue to normal growth, they would generate free cash flow of $45 million from Omni and $106 million from Forward, totaling $151 per year. Also thought, though, that cost synergies and return of revenue growth, free cash flow margins could be higher, around 10% for Forward and 8% for Omni, and this can mean free cash flow between $190 to $210 million. So if we look at just free cash flow multiples, if their fair value sits around 14 times free cash flow, that would put them in a market cap of about $2.8 billion, and a full value at 18 times puts a market cap of $3.6 billion. And with those assumptions, this indicates over an 800% potential upside based on higher free cash flow margins and modest revenue growth to their fair value. So this could be a fantastic opportunity, although there's just not enough confidence here to say that they're really going to turn things around. I'll be keeping a very close eye here, and we'll see if this company is able to get things under control going forward. So I'll keep you guys updated here. Appreciate you guys sticking around if you guys made it here, and I will see you guys in the next one.